REIT Activism webinar. I'd like to inform everyone that this webinar is being recorded and will be available for replay shortly after the webinar ends. This webinar will also be transcribed, and that document will be circulated within a few days. The replay and transcription will be available under the Events tab on our website, www.cefnetwork.com. We will be taking any questions asked during this webcast, so please be sure to utilize the Questions tab on your screen. At this time, I would like to turn it over to our moderator and Senior Managing Director at Alliance Advisors, Wahid Hassan.
Thank you, Teresa. First, I want to welcome all the attendees and expert panelists on behalf of Alliance Advisors. Alliance Advisors is one of the fastest growing proxy solicitation firms with over 400 clients. We work with some of the largest BDCs and closed-end funds. Given the rise of shareholder activism in the BDC space, we felt that it was an opportune time to discuss why activists are targeting BDCs and how issuers can prepare for an environment where activism is becoming mainstream. Let us begin with the introduction of our panelists. We are excited to have a very experienced group with us. Tom Friedman is a partner at Deckard. He co-chairs Deckard's Global Corporate Finance and Capital Markets practice. Cynthia Cruz is a partner at Sutherland, Aspel & Brennan. She advises public and private companies and the boards on all aspects of corporate governance and proxy fights. Phil Goldstein is a principal of Bulldog Investors. According to Shark Repellent, Bulldog has been involved in over 177 campaigns at 144 different companies. This year, Bulldog gained board representation through a proxy contest at BDCA Ventures, a BDC company. He also serves on several boards. My name is Wahid Hassan, and I co-head the shareholder activism practice at Alliance Advisors. Prior to joining Alliance, I managed the M&A and proxy fight practice at ISS, Institutional Shareholder Services. With that introduction, let's start with the first question, and this is addressed to all the panelists. Why do we see an increase in activism in the BDC space? Tom, let's start with you.
Sure. So I think there's a lot of different opinions on this question. I think some of the obvious factors that get repeated frequently are that BDC stock prices have been declining or they've been low for a prolonged period. There's also been some commentary about the fact that BDCs have relatively high fee levels as compared to some other types of investment products in the market. And also, recently, there have been some BDCs that have been affected by increases in non-accruals among investments, particularly those BDCs that are concentrated in investments in the energy industry.
Good. I would add to that I think what you're seeing in the BDC universe is really what's being experienced across corporate America. I think that you've seen, for example, some of the companies that you wouldn't necessarily believe would be subject to proxy contests, such as DuPont, having gone through a proxy contest and actually effectively won that. Now there's discussions about them merging with Dow. So it's basically there's nobody safe, or size doesn't make you safe in this context. And in addition, you've got one of the reasons that is happening is you actually have an industry that's grown up, that there's a universe of funds, about $130 billion, that is out there waiting to basically conduct activist and proxy contact campaigns. And as a result of the fact that that's out there, they've got to put money to work just like BDCs do. That's a tripling of the assets in that market. And effectively, activism, good or bad, has basically been moved or shifted into the mainstream. Hostile activity really isn't referred to the same way it would have been referred to back in the 80s. And so you're seeing a lot of success here with some of these funds. Keep in mind that not necessarily everybody goes to a contested situation. There's a lot of activity that you'll see in a very informal way. So all of those campaigns, if you were to look at them, there's basically there's an increase in the number of campaigns that are even out there today, and that's what basically is happening with BDCs. And you can actually compare it to the REIT market as well, the same type of discount issues as well as some of the asset issues and fees are being raised at the same time.
Phil, what's your take on this?
Well, I think that BDCs are a little different. It's you know, when I look at it, I kind of think, well, what's taken so long? And I think there's two different types of activists. There's the type that wants to manage the assets. So basically looks at the you know, I don't know if the other panelists disagree with me, but fundamentally, the whole structure of BDCs is flawed in that the fees are so high that it's difficult to see how most shareholders are going to earn a decent return over time. I mean, when you have 2 and 20 and regulatory costs and so forth, it seems like it's just you know, there's been so many abuses, issuing stock at below NAV and dilutive secondary offerings. So there's been a wealth of abuses, and you know, I kind of look at it and say, what's taken so long? But the two types, one of the type, the type like with TPG and the next point would both like to manage TICC. You know, when you combine that with terrible performance and a big discount, you can see why that's attractive. Then there's the type of activism that we're seeing right now at 5th Street, which is where a passive investor, River North, as far as I know, which has never engaged in activism. I know them from closed-end funds, but this seems to be their first contest, and they look at a big fat discount in addition to the other factors of the high fees and the terrible performance, and they just want probably to close the discount. They don't really care. They're probably looking for some sort of liquidity event. So I think I think Alliance is going to make a lot of money over the next couple of years because there's going to be some successes here, and when it's going to make the industry much more competitive, whereas before managers and boards just kind of, you know, thought this was just a pile of captive assets. It's that seems to have changed, and I can only see it accelerating. I just want to give one example of what I see the problem on TICC. I mean, you know, they've been having this litigation, and basically the manager wants to sell out to Benefit Street Partners, which apparently is a good manager, but the former manager or the existing manager wants to get paid. And you know, frankly, even if the board's sending out a letter saying, well, you should vote for this deal, the new manager, which I think, in my opinion, has no chance of happening, but even if it did, you know, if I'm on the board, I would say, well, why don't we just tell Benefit Street, why don't we just hire them and fire the existing manager and take whatever they were going to pay the existing manager and put that into the fund? And I can't really think of a good answer that a board or counsel to the board would give that would be consistent with fiduciary duty not to pursue that. So I think the boards are going to be very uncomfortable with credible managers looking to replace incumbent managers who have performed poorly and charging high fees if somebody offers to come in and do the job for lower costs and takes other shareholder-friendly measures.
Thank you.
I want to, so just so we don't, we get into it, Phil, I think that I can actually speak for Tom here. I think that we specifically disagree with a flawed structure. So I do think that basically a lot of the structural terms such as fees as well as issuances are really driven by the market itself. And to tell you the truth, I think that actually you're somewhat proving out whether the market drives those or the statute drives those, because, for example, the fee structure under the 40 Act is not, the 2 and 20 structure is not dictated by that. And the ability to have not basically an asset fee and an income fee, that's something that's been driven by the market. And I think that you've seen some people responding, or management teams responding to moving that down. And I think that that's something that's been happening in connection with IPOs. So, and then the issue that we always hear about is the governance, is that the shareholders approve effectively any type of a below NAV issuance, and that's required by the statute. So I do think that one of the things you need to be careful about when you're looking at this type of a product is that there is a 40 Act structure here, and you have to take that into account when when either an activist or a board and management team is kind of responding to any kind of activist activities. But I just want to go on record that I disagree, and that the a board is basically put there as the gatekeeper for these funds, and the board are the ones who look at the advisor, and having them be the ones who are reviewing that and then having that go to shareholders is the way that the 40 Act works. So.
Well, that has been the way it worked, if you call. I'll put the word "worked" in quotation marks. But I think what you're seeing now is, up until now, there was never really any competition for the management contract. And once you know that genie's out of the bottle now. And I personally have gotten calls from credible managers who are looking to do the same thing. So I think that's just, look, you know, things can go on a long time with, you know, and everybody thinks it's working, but now it really is market forces, and I think you're going to, you know, things have radically changed, and the market now is starting to work.
Phil, I think, you know, that I wouldn't necessarily disagree with everything you said, but I think that there is a point there. 2 years ago, a lot of these same managers were not considered terrible, partly because loan assets generally, the pricing levels were higher, and obviously now with loan assets having traded down in value across the board, not just with BDCs or closed-end funds, there's obviously an arbitrage opportunity here. I don't know that merits, you know, an across-the-board condemnation of managers of BDCs, but I wouldn't disagree. There's an opportunity here. Somebody is going to gain that increase in value if the loan assets trade up later, and, you know, I don't blame activists and others from seeking to share in that increase when it occurs, if it occurs. But, you know, last year or 18 months ago, BDCs were trading at, on average, about 5% above NAV. It just wasn't that attractive. It's not that people didn't think it could be done. It was just not that attractive to try to take over a fund trading above par. I
agree with you. And I didn't mean to say across the board, but I think there's more than the more you know, either bad or disreputable managers in the BDC space than in, say, the closed-end fund space. And maybe they're just attracted by the high fees, but you're right. Of course, when they were trading at or above NAV, you know, maybe that wasn't as apparent. But
I have to jump in on this because when you're talking about the managers, I mean, part of what we were talking about, and I was disagreeing that the BDCs were a flawed structure, just to be clear, not necessarily on the other statements that Bill was making. But the point is that the market forces, I think, are working here, and one of the things that when you're looking at an activist or campaign circumstance, I don't know that necessarily all those could be considered successful. I think that I mean, Phil, you're involved in 2 BDCs that I think are actually, from a market standpoint, trading at the lowest level for their pricing, the First Hand and the MVC, and I think that those were both campaigns that you had launched. So it's not a panacea.
Yeah, first of all, I was not involved in MVC. I'm on the board, but I was never involved in any activism with MVC. BDCV is in a liquidation mode, and also I would distinguish, though, those are equity-oriented BDCs. Look, I mean, there are problems, which are you're the minority. There are problems with all BDCs, but because of the opacity of the assets. But I think this call, my understanding is pretty much confined to the income-oriented BDCs, and you know, they have pricing problems. I mean, you know, there's a lawsuit. I'm not going to opine on the merits, but again, on Fifth Street, where the allegation is that the manager was refusing to take write-downs because the manager wanted to issue an IPO of the management company and was artificially inflating it to keep the fees up. And you know, there's a lot of concerns about that. But anyway, the bottom line is the activism is going to probably continue, and you know, we can disagree as to whether BDCs are a flawed structure. I just think when you have expense ratios, you know, in the 4 or 5% range.
Yeah, I think we can all agree that activism is effectively here to stay. I think with proxy access, which I think is one of the reasons that all of this is kind of moving into the mainstream, that there's definitely going to be more activities, and boards and management teams need to be more informed, as well as the activists, because not every activist, I think, is the same. It may look like the same playbook, but I think that you have to, just like you have to distinguish between companies, you have to distinguish between activists.
I agree with that.
So maybe we can spend some time trying to understand, like, what made you transition from a mutual fund activist to a BDC activist, and how do you identify the targets?
Well, I wouldn't say we transitioned. We just happened to see an opportunity where, I mean, in the case of BDCV, it was a small enough fund for us to handle, small enough BDC, and also the management agreement was transferred to an affiliate of Nick Shorish, who, if you haven't been following the news, has had more than his share of problems. So once that came out, we just saw no future for that fund, and it was trading at a 25% discount from NAV, and it was a pretty easy proxy fight to win. I mean, that said,
well, I'll just get our moderator to weigh in on this, because actually I think the ISS supported the current management, and I think it was as a result of the plan that had been laid out by the management team, and that I don't think that they felt it was laid out in the public documents by you, Phil, or your group. So I don't know whether, Wahid, do you want to talk about that? I mean, and how ISS plays into this?
I don't think ISS has much effect on BDC votes. I mean, sometimes, you know, if you want to start talking about ISS, I mean, there are times when we agree with them, and there are times when we don't. And in this case, I don't think they got it. I think that there was no future for this fund. But, you know, look, I mean, ISS, like everybody else, is entitled to its opinion. And it turned out, but the problem with, the reason why ISS is not really much of a factor is because there's very little institutional ownership of BDCs, and the institutions that own them now are much more likely to just vote, their own interests and ignore what ISS says, and so I don't think they're much of a factor like they would be in an operating company like a DuPont.
Right. And I feel like with respect to ISS, the challenge, the key thing that people have to be mindful of is ISS only influences a certain portion of the ownership. With BDCs and closed-end funds, a lot of these are primarily owned by retail investors who don't tend to follow ISS, neither do they subscribe to ISS. Now, BDCs or closed-end funds that do have some institutional ownership, in those cases, yes, you can influence ISS to recommend for you. But again, it's an advisory board. There's a huge, like a whole engagement strategy that has to be pursued, like how do you reach out to retail investors who tend to be management biased to begin with, and how do you convince them to vote for which side? So we can get into that, but let's move on.
Yeah, I might add one other thing, and this kind of goes to the structure point that Phil raised. I think that one thing that makes certain BDCs very attractive is that because of the quirks of the 40 Act, management can get into a situation where it's difficult to move to improve their own performance. They can't raise capital, they can't incur additional debt, and there's only so much you can do in terms of shifting assets around to different names. And I think that obviously it's just like closed-end funds, so I think you get into a situation where you're dead in the water, and it obviously makes it attractive if someone is trying to just aggregate assets.
So moving on, this is for Tom and Cynthia. Like, how are you advising your clients to deal with this activism thread?
Yeah, I mean, I'll go, and Tom, please stop me if you want, as we walk through some of this, is effectively, I think one of the most important issues is the composition of your board. And I think actually Phil would agree with me on that, is that the people you put on your board, their background, their experience, their understanding of the business, that is incredibly important, and I would suggest to people that they look at their current boards and see if they've got everything, every type of experience they need filled out, and if they don't, they might want to review that and either add people or consider, what else to do. But I really believe that is one of the primary areas, because unlike years or maybe 5 years ago or so, you would not see board members being as active in this type of area. You would likely not have them out talking about your company. You would mostly have left that to management. I believe that's really shifted, and I do believe that's going to continue to shift, especially since they have such an important role in these 40 Act entities, where you have to have at least a majority of independence. That lead director or chairman really takes on an incredibly important role, especially in this type of an area.
I think that's right. I mean, one other area that we tend to focus on, and I'm sure you do as well, Cynthia, is pushing boards, and particularly independent directors, to take ownership of the annual renewal process on the advisory contract. That's an area where, there's a huge range of practice in the market, frankly, and I suspect that goes well into open-ended funds and closed-end funds as well as BDCs. But, independent directors can, insist on certain information being provided. Sometimes they do, sometimes they do not. I think that it's important, in the selection of your peer group when you're comparing performance, that you try to get an objective data set and not, just a kind of a cherry-picked group. I wouldn't say any of the clients I work with have cherry-picked, but I think it's certainly open to being done, because you can kind of pick your sample as management. And I think it's incumbent on the independent directors to kick the tires on that and press and make sure they know what the market rates are and the structures of fees, so that they're not an outlier. And I think that can go far to kind of eliminating someone's argument in an activist situation that there's some different fee structure that they can bring to bear that's going to result in enhanced performance for shareholders.
I couldn't agree more. I mean, that 15C process, which is what we're talking about for boards, where they have to annually approve the fee structure, that you really do have to take into account what's happening today when you're going through that review. And I would think that boards would want some information about that and what's been transpiring, so they have to be very informed. and that really that leads on to what my second point, which would be performance. One way to inoculate yourself is performance, and not only the management team but the board has to be addressing that constantly. I mean, you used to look at some of these issues on a quarterly or even on an annual basis. Honestly, a lot of the strategic issues that boards are looking at really need to be done, as often as they're getting together, and they need to make sure that they're educated.
Can I add just my 2 cents on that? I think that I don't disagree about the importance of the board, but in addition to having good paper credentials, I think and I don't really know how this works, but I think it would be helpful if the board has significant skin in the game, meaning every director should have a significant investment in that BDC. That's not a guarantee that the BDC is going to perform well, but it certainly aligns the interests of the board with the shareholders. I don't know how that actually, what the actual facts are, but that's something I would look for. And if I was an activist running against an incumbent board and they had no stake in the BDC, it's certainly an area of weakness.
Phil, to your point, when I was at ISS, this issue would often come up, that the incumbent directors don't have skin in the game. And in our conversation with the incumbent directors, one issue that would come up was skin in the game is a subjective term. For somebody whose net worth is like $500,000 or $1 million, for them, investing $100,000 is a skin in the game. Whereas you talk about a large institutional investor or a hedge fund, for them skin in the game means millions of dollars. So it becomes very difficult for institutional investors, property advisory firms, and people who are not part of the process to determine whether someone has vested interest in the company as a director or not.
Well, that's true, but I think if you're making, let's say, I don't know what typical director makes, but let's say he's making $60,000 a year. I think putting a third of that into buying shares in the market is not unreasonable.
Well, what I will say about this is, unlike most of the issues that come up, there is not a 40X restriction on boards owning shares in a BDC. So I'll go on to my next point, which is really knowing your shareholder base. And that doesn't mean getting to know it when basically you've got somebody who's come in and wants to put a slate of new directors up. You need to be aware of it, and actually BDCs probably have more information than they're thinking about, because they've done some of these other votes that might require you to go deep into the base of the shareholders. So it's one, knowing who they are today, and as you build them, as you're doing additional offerings, who's coming into your stock, understand and who they are, how they act, and monitoring and working with the advisory firms on tracking that information. So you really do need to understand that and promote who you want in the stock. And I would say when and if Phil comes into your stock, you should be aware of it. And if he writes you a letter and asks you questions or makes suggestions, that's something that both the management team and the boards need to take very seriously. And not necessarily that you're going to agree with him on everything that he's suggesting, but that those types of things, those are strategic issues that need to be vetted throughout the firm, and there needs to be that type of significant engagement with the shareholder base, and that's the world we live in right now, and I think it's only going to get more significant on those types of encounters.
That's a good point. One challenge that we have seen among our clients who have a large retail ownership is when you have a significant portion of OBO shareholders, objecting beneficial owners, it's difficult to reach out to them and to know who they are. So again, it goes back to your composition of the shareholder base. If you have institutional investors, it's easier to engage with them and to know who they are and to track them. But if you have a large portion of objecting beneficial owners, there's very limited visibility that the management and the board have on who these people are. And some of our clients have used like other proposals in the past to sort of gather a database of who these investors are. So if they are in a contested situation, they can reach out to them and say, hey. But again, that information tends to change as shares trade over time. And some issuers tend to use like market surveillance services that tracks on a regular basis the shareholder base. But you're absolutely right. Keeping in touch with the shareholder and not reaching out to them only when you need the vote is the best strategy over here.
Well, and I'll just say, I mean, just having a shareholder day, you know what I mean, or brown bag lunches or something. I mean, you're talking about retail shareholders. They want to understand, and in a BDC where maybe it's a fund at the very top level, but the underlying portfolio companies, giving them more information on what type of investments you do have in your portfolio, which is all public, but it could be very, very helpful for a shareholder to understand, you know, potentially using your annual meeting for some of that. It really is something that's going to have to be done. You're paying them dividends, you know, hopefully fairly regularly, and if you know, to the extent that you can use that vehicle in any way to keep assessing them. I'll mention one thing that I heard in connection with the MCG. That was a merger transaction, but there was the activist, I'll call him an activist, Phil Falcone came in, and ultimately MCG or Pennant Park prevailed to close that transaction. I do believe that some of that was the outreach to the shareholders, meaning that I know that the company basically was on the phone talking to people, you know, from the beginning of the day to the end of the day. You could have hundreds of calls throughout that whole process, and I believe it was really that not only the letters and the information provided, but it was actually that work on the phone, which is a lot of drudgery to get that all accomplished, and takes away the resources from operating the business. But sometimes that's at some level that's what it takes. It's going to become a cost to the business to basically make sure you know who your shareholders are.
I would just add that it's fine to know who the shareholders are. It's very difficult when you have such a dispersed shareholder base. My impression is that I suspect that a lot of shareholders of BDCs have no idea what it is they own. They were sold this as you get a high income and don't worry about where it comes from, don't worry about leverage. And, you know, they don't even know what it is they own. But that said, I don't think it would hurt to have, and some BDCs do it, maybe more than some, should have earnings calls, you know, every quarter or. You know,
yeah, I think they do, Phil. I think that your point is correct, though. I think for most of these retail investors, even if it's, you know, an announced earnings call and they have it every quarter, I think retail typically doesn't participate. I do think this is an issue that's kind of hard to get around. For a lot of retail investors who are, as you say, sold on the product because it generates regular high current income, and most of these BDCs continue to produce that income, you don't have most of the retail investors kind of marching in the streets. I think certainly if they start seeing real erosion in NAV in their statements, you know, that might move them to support activists. But I think for a lot of these, they're fairly passive and they're not really reacting other than if their dividend is cut.
Right.
Well, but you want them to be active enough to respond as you need them, or to you know, weigh in on who they want the manager to be. I mean, that one thing that operating companies have started doing is having a separate call to the earnings call, discussing some of these more what I would consider governance-based issues, and maybe that's something that might be adopted by some of the BDCs, because I don't think you can just throw in the towel and say you can't get to them. Because then,
I agree.
Then
I agree.
You'll have funds that are, you know, zombie funds.
I think that's right. I think it also matters a little bit which group, you know, approaches you. As if an activist group approaches you, you know, if it's someone that has a track record in the industry, and obviously understands the asset classes that BDCs invest in, I think that's one sort of an issue for a board to deal with. If it's someone who really has no track record, I think that's a very different consideration for the board, because there's no assurance you're going to trade out for something better. You may just trade out.
That's true.
On the NAV issue, and in the closed-end fund, NAV discount seems to be something which is persistent, and a lot of boards that I talk to have difficulty in trying to come up with a game plan that will reduce or permanently reduce the NAV discount. So if NAV discount is the core area of contention in BDCs, so how are boards thinking about it? And Phil, from your perspective, is that the only thing you look at?
Well, what's the question? Is that the only thing you look at?
Yeah, is NAV discount the only metric that you look at in order to decide which fund to go after?
No, I mean, obviously, when I'm looking at it as an activist, it's the same as with any company. There's three fundamental. First of all, you want to be able to buy something that you do feel the intrinsic value is significantly greater than. So obviously, the discount has to be there. Otherwise, it's pointless to. There's no money to be made. But the second thing is what is the shareholder base and how likely are you to win? And then lastly, is the performance itself, because if a BDC has had good performance and the NAV itself has done okay, but the discount is widened, I think that's something that the manager could say, look, we've performed pretty well, but if there's been write-downs and the NAV has fallen and the discount is widened out, that's going to make them, it's going to put a pretty good bullseye on their back. So, but certainly without the discount, there's not going to be any activism, because there's no money to be made unless it comes from the managerial activists. But I doubt that they would want to get involved unless the fund is trading at a discount, because they're going to have a very tough time winning a proxy fight.
I would just say that the companies, and I think you just heard it from Phil, who's out there, actively in campaigns, is you got to look at your vulnerabilities. The board has to look at the board and the management teams need to look at that, and they obviously need to try and make sure that the market knows what their plan is, whether it's repurchasing stock or or altering fees in some way. Those are all things that the board needs to take into account. And you would rather have your board do it than necessarily having somebody externally do that for you. So that's what we would suggest, that basically the board take that very seriously. I would want to move to just a thinking is an engagement plan. So we've been talking about what happens in a market that might make an issuer potentially a target of a campaign, of an activist. But what can you do in advance of that happening? And the real point are the things that we've already talked about, but also you really need to educate your board about what this process is all about. What what type of filings they'll see, what kind of statements will be used, the language that might be used. This reputation's a real issue here, I think, for some boards. And just because you don't like somebody or don't care for their arguments doesn't mean that you can just ignore them. You need to make sure you've got the right individuals helping you out, meaning whether they're bankers or lawyers or solicitors. Make sure you've got the people who are educated, been through this process, and the board understands this. You don't want to be talking about the type of issues that might come up, whether you're talking about a classified board or advance notice provisions or pieces of litigation for the first time ever, when you're basically having to decide whether you're going to basically fight somebody or agree to add somebody to the board. Because one of the things that's been happening outside of the BDC space specifically is that there's a lot of campaigns that aren't going to a contest where an additional board member is added, and then it'll clear whether necessarily that's going to be successful or not. But and then when you get to a actual contests are increasing, but the management teams, because so few of them are going actually to a full-blown contest, are actually sometimes winning. So you can't assume that you're not going to win at the outset. You have to be committed with your story, your message. It has to be one voice. You have to explain it to everybody in whatever terms that they can understand it. You really have to have that engagement plan in place and have your internal and external teams kind of ready to go. I mean, again, I'll say that this world is not going to, we're not going to put this genie back in the bottle.
I agree with Cynthia about that. I also agree with her about engaging with the activists. To me, that's a no-brainer because there's no downside. It always pays to talk because you may be able to reach a settlement, a resolution, and if you can't, well, you didn't lose anything except a little bit of time. And it also I think it helps to just have that conversation because you're dealing with a human being, and ultimately you may settle. And if you don't really know who you're talking to, it's very difficult to have an understanding of what they're willing to do.
So moving on, Tom and Cynthia, you've been involved in a number of proxy fights. So what are the key winning strategies for issuers over here? How do they win a proxy fight?
I think Cynthia just hit them, but we can reiterate. I mean, I think having a team assembled that understands how to deal with these issues, particularly advisors, financial and legal, I think are crucial. I think having some notion of what the market is so that you have a sense of whether, to push back or to accommodate. And then, reaching out to shareholders early and often is probably the crucial thing if you end up in this battle, because it does come down to, as Cynthia mentioned earlier, phone calls and more phone calls and trying to, articulate an argument as to why the incumbent management should stay in place.
I would say the question that I think the management team board and everybody needs to think about even more is what does winning mean? Mm-hmm. Because I will say that having been through several of these and actually several of them in the past year, this is a battlefield, and I'm not sure that everybody's prepared on a day-to-day basis to deal with the onslaught of publicity and the messaging and the press releases, the websites. That is some, and those are the types of things that you're going to be talking to that your board's going to want to weigh in on. So that the time and effort and unfortunately potentially distraction if you're not careful from your business, you really have to decide on what you're going, how you're going to go about this. And if, for example, if you're going to fight, are you going to go to the ends of the earth to basically get involved in litigation? Remember, when you're before a court, both voices in that court, regardless of who owns what or who has contract, has the same level of authority to be there or standing to be there, better stated. So it's you really want to make sure you've got this an informed understanding, and I think that may very well be why some of the people are not going necessarily to full-blown contest. But again, I would just say that this is not something that you need to be thinking about when you're talking to people about your annual meeting, or you're worried about your election of your directors. This is an all-year-round issue now. It is not something that you that you can wait for, because the activists, good, bad, or ugly, are coming in, and they may very well demand something be at a special meeting, or again, they don't even have to necessarily be mounting a contest. They can write a letter and put it on, attach it to a 13D, and throw a company into basically a lot of issues. And so there's a lot of different ways for this to be drawn out. I mean, actually, I read something that was surprising to me, that that actually the activists, over 60% of them that are involved, own less than 1% of the companies they're involved in. That's a universe of all companies, not just BDCs. But I thought that was extremely interesting. And your board's got to be ready to basically withstand the statements that are going to be made about them, whether it's through the press releases and that, or websites or whatnot. But not only the people who are involved. There's analysts, there's market, there's newspapers. Everybody loves drama. And that's going to be something that's going to, not many directors want to be necessarily reading about themselves on the front of the Wall Street Journal. So it's really something that you have to really spend time and think through how the company is going to respond.
Let me throw out a thought. I mean, you're always assuming that there's going to be that the board and management are aligned, and that the activist comes along, and now you have to dig in. We decide whether you want to dig in or settle. I don't know of one example, and this I think is very telling, where the board was proactive and said, you know what, this manager has done a terrible job. We're going to get rid of him. We're going to bring in somebody much better at a lower fee. We're going to take shareholder-friendly actions, trading at a big discount. It seems like, you can point to the 40 Act and securities laws and state laws about fiduciary duty all you want, but the reality is that the boards have pretty much been rubber stamps for the manager. I mean, that's the reality.
There are examples where people have terminated operating agreements. I mean, it may not have been as, kind of in lights as an activist battle, but there are certainly instances where boards have terminated operating agreements or management agreements for external advisors.
Pretty rare.
Maybe, but I mean, the point is the statement that boards. I mean, I think for every board that does it, there are probably many that think through the idea in connection with their annual renewal, and some of them go forward and some decide not to. But I think there is this sense that boards are rubber stamps. I don't think that's actually, at least based on my experience, and Cynthia, I'd be interested in your experience. I mean, that's not what it feels like when the advisor is trying to get its fees reapproved. That is not the feeling in the room. So, I'm sure that from your perspective that's the case, but I haven't had that experience.
I couldn't agree more, and I actually think if you in the market now, there's people who are looking at their fees and reassessing, and I don't think that just necessarily the outcome is indicative of the fact of what kind of discussions went on or what was presented. And I would say actually in connection with the IPOs in the last couple of years for BDCs, just as an example, a number of those companies waived their fees in the first year or so, first 6 months is how they ramped up. They're the ones who came up with the total return and the high water marks. I mean, that's one of the reasons those are being thrown out. And some of these older contracts didn't have some of that because the market wasn't necessarily demanding them. So I do think that those discussions go on, and at least that's my experience. And it may not be as evident publicly, but I think that there's actually a couple companies who've already responded to some of this.
By the way, to throw in a commercial for our MVC, just about a week ago, we did announce a reduction in the fee that was pushed by the board. So, it does happen, but not often enough.
And I just want to add a point to engagement strategy. So what we have seen in our experience, both at ISS and outside, is companies and boards need to have two distinct messaging strategies, and they have to simplify it. The biggest challenge that companies and boards have, they feel everyone understands the business as well as they do. And when they go out, especially and explain their strategy for whatever they're doing to retail investors, a lot of retail investors don't have a clue of how these businesses work, the underpinnings of like a debt strategy or like equity strategy and whatever the management is trying to accomplish. So I think for success, companies need to have two distinct messaging strategies, simplify them, one for institutional investors, one for retail investors, and just like Cynthia and Tom said, stay in touch with the shareholders and explain to them what they're trying to do, what is the plan to create shareholder value over the long run. And as long as the message is simple and easy to understand, people will support the management and the board.
Yeah. I'll give for BDCs, and I think that one of the reasons people can look at them and get a little more detail, that if you had a bank that was listing out every one of its loans like the BDCs do. There's actually a lot more information in there. I mean, it may not necessarily translate to how it's valued, but I do think that there's some in there, and that companies, the BDC management teams and the advisors can help get a little more meat on understanding that for a retail investor, because I do think that getting down to what BDCs do, make investments in middle market and small companies, is something that that somebody can understand. A screen door company or something like that, they may not necessarily look at all the multiples and how they're putting their finances in place and what their ratios are, but they can understand if somebody's providing a product. So I think that messaging approach really is something that we all have to concentrate on and try and do better for this universe.
Sure, great. In the interest of time, we can move on to sort of concluding remarks. What do we expect for next year, and key takeaways for investors and boards and management?
Yeah, I think I've already said it, is that I think we're going to see more activism, whether you're talking about activism from a standpoint of replacing the directors or challenging the advisory fees. I think that that's going to continue on, or even a sale process. All of those are pieces of this, and I think we're going to see more and more of it, not only in the BDC space, but throughout kind of corporate America. And I think as proxy asset access comes in, I think it's going to become even more, companies are going to be even more embroiled in that.
Yeah, I mean, I would echo that. Go ahead, Phil.
I don't like to make predictions, but and I think the answer to that question will depend on how the current campaigns, especially the one at Fifth Street and the one at TICC, play out. And but I'll go out on a limb and say I don't see anything that's going to stop this train or get other people getting on it if there is some success.
Yeah, I mean, I would add two things. One, I do think that you'll see probably some additional boards. I think in addition to NBC Medley reduced fees last week, you may see more of that. You may see introductions of breakpoint fees, which is something that people have talked about a great deal, but you have not seen much of in the BDC space. So I think you will see more of that kind of action without necessarily the pressure of an activist, other than the kind of an inchoate pressure that's out there in the market now.
I'll pass on to, since I think we have another minute or more, is that, I mean, there's an interesting process going on right now with American Capital. They, for I think over a year or so, have been talking about a spinoff. And there was an investor who came in, and Elliott Management, I believe it is, came in and basically challenged the spinoff and what was happening there. And almost, I mean, from an outsider looking in, almost overnight, they decided to basically go out and conduct they hired actually 2 investment bankers and conduct a process and increase the size of their repurchase program. It'll be interesting to see whether we even have much activism going on in that circumstance when you had such quick action by that particular board. Now, again, this is an outsider looking in. All of this could have been going on for quite a while, and I wouldn't know.
Thank you. We have a question from the attendee. How do RIC limits on BDC ownership impact activism?
I think you're talking about the investment company. There's certain limits on the 3% issue. Basically, the purpose of the statute is to not allow for pyramiding of fees. And so if you're a fund, essentially that fund, that individual fund can't own any more than 3%. An individual, just to be clear, can own whatever they want. So this is only applicable to pools of capital and where you're worried about pyramiding fees. So, but you can actually have somebody like a Fidelity or Wellington or something like that have multiple funds within that structure owning over 3%. So it really it depends on those facts and circumstances. I think that there's been some use of that tool in connection with trying to challenge the ability of some investors or activists to basically come together as a group. I think that's something you have to look at and take into account and analyze. However, I think there has been some cases that have basically sided with the fact that really that provision doesn't necessarily help you in the long run, because you can have several funds, you can have several individuals, you could have SMAs and that type of thing involved. It's not necessarily just because somebody is working or is a part of a solicitation that necessarily that they should all be aggregated, is what I'm trying to get to. So I think it's something that you definitely need to take into account, and you might use it in connection with a campaign, but I'm not sure that it's a be and end all.
Thank you.
I don't think it's much of a factor, because I don't think the fund registered investment companies are activists anyway, so I don't think it's much of a factor.
But I do think if you have groups, and I think this is one of the things that the SEC looks at every once in a while, is that if you have a group that's acting together, they should be disclosing it. So that is a better way to think of it.
I guess one other thing in the 40 Act that probably is obvious, but I'll just mention it, just the fact that to approve an advisory contract, you need a board vote and a shareholder vote. So the board remains important almost regardless of how the transaction evolves. You can never go straight to the shareholders without the board assisting.
Okay. Thank you. With that, we'll conclude the webinar. We want to thank all the panelists for their valuable insight. Tom, Cynthia, and Phil, thank you for your time. A transcript and recording of this webinar will be made available in a couple of days. Thank you all the attendees, and with that, we wrap it up.